I wanted to first say that this whole idea of inviting Tobias actually came from something Bart mentioned. He said, we want to know what's going on with financial crisis and perhaps with the franc and euro and what happens. And indeed, many of us don't really understand what's going on. And then we thought, you know, who could be a good candidate that we could grab and invite? And another Dr. Straumann mentioned you to me, actually, Ralph Straumann, said that we have somebody who knows these things and actually gives fairly open public talks. So that brought me to discovering Tobias's work, and it's very, very interesting. And I would like to say that he's a historian, sociologist, and an economist, and he actually lectures in both departments. So he belongs with us here at University of Zurich in the Department of History, but also lectures in the Department of Economy in Basel, but also has widely been interviewed by media. So other than that, I guess the background is that he has been also an international researcher, studied in Paris, as well as around here, and then spent some time in Berkeley, the University of California at Berkeley, and as well in Chinese University of Hong Kong. So hopefully has a global perspective also in terms of geographic extent of the thing. So I will not take too much more time. I want to welcome our speaker, Dr. Tobias Straumann. The stage is yours.
Okay, thank you very much for having me. And I'm going to talk about 20 minutes. It's rather personal. I'm talking about what has been unknown and has surprised me, now we know a bit more. So it's not representative in the sense that this is for the whole department or for the whole discipline. And of course there were people who at the time knew much more and really saw what was coming, but not for me. I mean, I think I was average. I mean, not especially bad, but certainly not especially premature in my judgment. All right. So I'm going to go first from the knowns. I want to talk about the knowns. As you know, the US financial crisis was the start of the crisis we're still in. Probably started in 2007. We had first signs of a downturn in late 2006, and as you know, it was the housing market. And at the time, and many colleagues, we knew very well that this American economist Shiller, perhaps you have heard of him, Robert Shiller, he published a book in 2006, and in his book you had this graph, and you saw very easily at the time that there was a housing bubble, enormous housing bubble. And what he really did very well, he put it into historical perspectives, and you saw that there had been some fluctuation of housing prices, but never something like this. So it was very clear that this was a bubble. Of course, you have to go back to, you know, like the 1920s maybe. Okay, that's the war, that's something else, but you easily saw that something was not in balance. So we knew very well that there was a housing bubble and that this housing bubble would eventually burst. But and we also knew, the historians, the financial and monetary historians knew that financial crisis is very normal. We have two kind of categories: banking crisis, currency crisis. Twin crisis is a combination of banking and currency crisis. You have different mechanisms how they are linked. Not so important, but we very well knew that we lived in a very unstable world. And you look at the period since 1973, you saw that banking crisis, this black column, they're re-emerging. In the period after World War II, 50s and 60s, we didn't have any banking crisis. But with the liberalization of capital movements, cross-border capital movements, with deregulation of the banking sector, we knew very well that this was coming back. And the currency crisis was very normal. We always had currency crisis. That's just that's not special. But we certainly knew that financial crisis can emerge. What we didn't know is that we're going to have a huge financial crisis in the core country, the industrial core country, because all these crises here are more or less linked to emerging markets. For example, in the late 1990s, we had this really huge Asian crisis, which was transmitted to Russia and then to Brazil, a little bit later to Argentina. So that was the picture, but we didn't know that this housing boom that would burst eventually would lead to something like that. But at least we were not completely surprised that there's going to be a financial crisis. And this is a very nice graph that shows again how there is some historical mechanism. It's what I just talked about. It's the correlation between liberalization and the frequency of banking crisis. This is the red line, is the liberalization. It's this scale. It's an index, so it's constructed. It's not. You can argue about how you measure capital mobility, but more or less, I think the trend is correct. And you see that there have been two waves in history since the Industrial Revolution, especially since the 1830s, when steamship, telegraph, trains and all that came, and you see with the increase of cross-border capital movements, and before the First World War we had really complete capital mobility, you see that you have an increase of banking crisis. And then the two wars and the Great Depression led to a complete repression of capital mobility, but then a new cycle started, and as I said, 70s, 80s, you see a very strong acceleration of capital mobility, and you see you have a lot of crises. And that's the Asian crisis. See, late 1990s. And Argentina, Turkey also had a financial crisis at the time. So we were familiar with that. But that's the US financial crisis part. So we knew there was a housing bubble, we knew financial crisis is coming once in a while, but we didn't know, or I think we didn't suspect that we're going to have a really huge US financial crisis. Now, in the moment, we're talking much more about the euro crisis, and many people think these crises are linked, the US financial crisis and the euro crisis, but that's not true. Of course, the US financial crisis was the trigger for the euro crisis, so when you look at the chronology, it's true. We had first this shock coming from the US. It weakened European banks, and it weakened, of course, also European states. But the root of the crisis, and I think that's very important to know, is not exogenously induced. It's and in contrast to the U.S. financial crisis, economic historians or economists, macroeconomists, were not surprised at all. It's exactly what we expected. It's happening now. It's not, of course, not the timing, the exact course of the crisis, but the causes of the crisis are completely understood. And while you can say that economists really failed in predicting the US financial crisis, that's completely true. Here it's the other way around. Most economists were very skeptical, have been very skeptical from the beginning about the Euro project, because it ran against all historical experience and what we know. And the basic tool or workhorse of the monetary history is this so-called policy trilemma. Maybe you've heard of it. It's very simple. You have three goals you would like to, let's say, fulfill as a government or as a country. You would like to have fixed exchange rates, or let's say stable exchange rates, not too much fluctuation. As for example, Switzerland now, we had a lot of fluctuation in 2010-11, and it was not good for our economy, especially for the exporting sectors. So you would like to have some kind of exchange rate stability. That's goal number one. Second, you would like to have capital mobility because it's more efficient. It's It's not nice if you have to have a license for every time you spend your vacation in a foreign country, as it used to be in the 1950s. It's nice, as a firm you can shift back and forth or export back and forth your goods and services without having a license and so on. So it's really good for an advanced country, you have capital mobility. For emerging markets it's maybe a different story, but for advanced countries. And at the same time, the third goal, you would like to have some room of maneuver for your monetary policy. And it's very easy to understand. You know, you have different countries, and these different countries have different business cycles. They may be similar to each other, but they're not identical. It can be that, let's say, Norway is very dependent on the oil price. We have, for example, overproduction of oil. The oil price drops enormously. So let's say Norway goes into a recession while the rest of Europe is doing just fine. Maybe even better because they're importing oil. So Norway needs its own central bank to fight this recession, because otherwise there is a danger that the recession is becoming even worse because the central bank is not able to tackle the problems. Or you can think of a banking crisis like Switzerland had in 2008. You have a really big bank which is linked to, let's say, US. US has a financial crisis, it's transmitted to one of the big banks, and you need to have a very active monetary policy to prevent the whole financial system of Switzerland from collapsing. So that's the third goal. You would like to be independent in your monetary policy, but you would like to fix exchange account. And now by trilemma, because you can't fulfill all three goals at the same time. There are maybe periods where you have no problem with that, you have no trilemma, but over the long run you have to decide what you want. Do you want these two advantages and you forget about this one, or these two and this two? And now you can divide the whole monetary history of any country, but certainly of Europe and the US, into different stages. Like 100 years ago, or until about 1931, we had the gold standard. That means the paper money was linked to gold, and every central bank had to have in its cellar like 40% of notes in circulation had to be covered by gold. So it was a very stable monetary system. But under this system, you had a very fixed exchange rate because every currency, of course, was linked to gold, and as a result, every currency was stable. They were stabilized to each other. So you had a very stable world in terms of exchange rates, and you had free capital mobility. In the 19th century, you just saw the other graph. You know, very nice. There's actually a very liberal era here. Then here the gold standard collapsed, but in this period, in the period of the classical gold standard, it worked quite well. But at the time, you had not as much independent monetary policy as you would have liked, especially in the 1920s and 30s. Then in the interwar years, because the gold standard did not work very well, this world economic crisis was just too overwhelming, and they would have needed really an independent monetary policy. Gold standard broke down, and as a result, the world shifted to another system. Bretton Woods, that was after World War II until the 1970s. They had now new priorities. They said, as a result of the world economic crisis of the 1930s, capital mobility is bad for us, it's too dangerous, we're going to restrict that, as you saw before. We want to have back independent monetary policies, but we also like to fix exchange rates. And for about 20-30 years, that system was quite stable, and you saw there were not many banking crises. But then in the 1970s, it broke down. Why? Because it was impossible to control capital mobility as trade relations, international trade relations were booming. You know, the more trade you have, the easier it is to shift capital back and forth, hidden behind fictitious good transfers. So, as a result, this system broke down and we ended up here. Since the 1970s, the yen, the British pound, the franc, the US dollar, the Australian dollar, and so on. So all the major currencies have had free floating. So that was new, a combination of capital mobility and independent monetary policy. And it suits very well, I think. It has many disadvantages, of course, but there is one big advantage that whenever you have an unstable financial market, banking crisis, recession, you're able to react quite quickly. Now, the euro is quite of a reversal of this movement from here to here. They're going back to some kind of gold standard. They have now capital mobility, permanently fixed exchange rates, as you know, Germany to Spain, Germany to France, France to Italy. You cannot devalue anymore. It's completely fixed. But as a result, you don't have any independent monetary policy. That's what you see now, for example, Italy. Italy has had no growth for 15 years. They should devalue their currency, they should have a much more expansionary monetary policy and so on and so forth. They have no chance. The ECB can try to help them a little bit, but it's not easy. These transmission mechanisms are not very well working. You have the Eurozone or the central bank interest rate is almost zero. In Italy it's about 4 or 5%. So there's something is broken in this system. And that's why really a huge majority of economic historians and economists were very skeptical. But if you go back to this system with a common currency, you need to transform this economic union into a political union, fiscal union, and so on and so forth. You cannot stay here and running the euro system as a gold standard, because as we see now, it's too heterogeneous. You need rebalancing mechanisms and so on and so forth. We maybe can talk more about it. So it's very strange. The US financial crisis was a really nasty surprise for many people like me. The euro crisis, not at all. Not at all. It's what we expected, and I can tell you, we also expect that this is going to last very long, and probably if they're not changing the whole institutional framework, it's going to crash someday. Of course, we don't know when. It can last for another 10 years, but it can be 2 years. I don't know. I would never dare giving you a date, but if they go on like this, this is a recipe for disaster. This is not working. And I think the historical, empirical experience is very clear in that respect. So because there is, in a way, theoretically not much to learn about, I would like to go back to the US financial crisis and tell you about the unknowns and the surprises. And there is, of course, not a clear boundary, but this is all, we're already going into unknown territory. Myself, I was aware that the old days of banking were gone in the US mortgage market. The old days means that we, as depositor, we bring money and the bank gives credit to a homeowner and that's it. So they have on the liability side our money, and as an asset, on the asset side they have the credit, and the collateral is the house. So they can, you know, if the guy fails to pay back, they can seize the house. So the bank is still in good shape. But I knew that this was over, but I didn't know the extent of structural change. And this is that was the new model. Maybe I show you right away the next slide. That is the new kind of banking, which in the mortgage market, US mortgage market, and it's more than 50%. I was not aware at all of that. I just simply didn't know, and I didn't care about it. Because I thought it's not important how the banking system exactly works. And you can argue in a way it's still cash is coming from one side and there is a credit going to the other side. But that's really the unknown stuff already. So you have a homeowner, they're funding it, he's giving the loan, and now this is transmitted to other people. It's you know, that repackaged and all that, and at the end you're somewhere in Germany German Landesbank buys all this crap. But they don't know anything about the homeowner. They just think it's a very good paper. As you know, the rating agencies gave them AAA and all that. But yeah, you see that there is a huge distance now from the homeowner to the institution or the investor at the other end of this food chain. And of course that changes the game completely, because the bank that generates this credit may know about the risks, but they don't care because they can give it to another party. So you don't have this risk screening anymore as you used to have in a very traditional banking system. And they don't care if the homeowner doesn't pay back. That makes it very unstable, and I wasn't aware of that. And as I said, especially I was not aware of the extent to which that was had been developing. And then that's only one part. The next part, and that was completely unknown to me. Of course, financial economists knew about it, but I think they underestimated the vulnerability of all that. You have this mortgage market, but the whole financial system in the US was based on short-term liabilities. That means the old days when banks were mainly using our cash was gone. Our cash was maybe 5 or 10%, and the other 9% was short-term money on the wholesale market. And the way you could get that money from the wholesale short-term market is by giving some paper, anything. You could give mortgage-backed securities, you could give shares, whatever. But the important thing is what you see here. It's a so-called repo market where every day millions, billions, trillions of money was going back and forth. On the one hand, the money was going in one hand, and in the other direction you had all these repos. That's all papers like shares, as I said, shares, credits, mortgage-backed securities. So you had a money market fund. They had a lot of cash from investors, and then they gave it to investment banks, and in return they received securities as collateral, as safety. You know, it could be anything. It could be a share of UBS or of ABB or whatever. And there was a middleman that just made it possible. And there was some risk that you always had a 3-hour window when these new trades were settled, made and settled. And that was, of course, very dangerous whenever one of these papers or one of these repo paper was decreasing in value. So it was very, very widespread trading between different financial institutions, and it was actually the core of the modern financial system. And now you see what happened to Lehman Brothers in 2008, and this is a complete surprise now for me. That's what they used for this short-term money stuff. So to have short-term money from the wholesale market, they used this repo, these papers or these shares, you know. For instance, they have US treasuries, those are 3-month bonds of the US government. This is very good, that's very safe, that's the safest asset in the world. To very, like ABS, mortgage-backed securities, what I just said, to very dubious papers. But the market worked, the market was accepting this kind of collateral exchange for short-term money. And you see, once confidence is collapsing, or the market is not convinced that these papers here, these assets are worth something, it's collapsing very quickly. Because the whole market is based on this short-term confidence game, and once it's gone, it's complete, it's over. You see that in, let's say, still in August, everything was fine, but here the market did not trust these papers anymore, this collateral anymore, and it was collapsing. and they were losing so much cash, they had to sell everything, and they were illiquid and had to close their doors. Now, for the last slide I show is, for this topic, is the extent to which this short-term market was dominating the whole financial system. This is 4 trillion, 2 trillion, 25 trillion, 1 trillion, 40 trillion. So here is the cash coming in. Those are the traditional banks. And to get this cash from all these funds, they had what I just showed. They had this parallel banking system. They were generating all these assets. In exchange for the cash, they could then borrow to consumers and corporate clients. So you see, that's a huge chunk, and these numbers are just mind-boggling. You have 40 trillion US dollars. And that was a very vital market, and it was kind of the center of the US financial system, and for the whole world, for commercial banks like UBS or Credit Suisse, everybody was participating in this wholesale market. And it was extremely vulnerable. And I was not aware at all of that, but it explains why a small change in the US housing market led to a collapse of the financial system. But that was for me a total surprise. What I thought you would see some bankrupt banks in the mortgage market, and that's it. But because these mortgage-backed securities were used in the financial system to get more cash for other business, everything was linked to everything else, and just a short change, a small change of the value of these assets had this enormous impact on the whole financial system, and that was a total surprise, and I'm still struggling with understanding what's going on exactly in this market. But it's still there, by the way. It has not changed. It's still based on this on these wholesale markets. So that's one of the very big surprises. And coming to the end, the next really huge surprise was then from the US mortgage market to the whole financial system, spreading around the world, and then to the real economy. That's my last slide. It's not hard to understand. You see two lines. The blue one is the Great Depression of the 1930s. And here you see the months since the peak of the business cycle. So in 1929, the peak was in June 1929. Afterwards, markets came down, trade, industrial production, and world equity markets. So that's the blue line. And that's the worst financial and economic crisis we have seen in the last 100 years. And the red line is the present. It starts in April 2008. In April 2008, the business cycle was shifting or changing. So it was the peak of the boom was in April 2008, and then you count the months, and like this you can make it comparable. It was made by two colleagues of mine, two economic historians. When they were posting these graphs on the internet, the server broke down immediately because people were so afraid that now the Great Depression was being repeated. And this website was some really small website, interesting for economists, but all of a sudden it went through every newspaper in the world. We were heading for another Great Depression. Because the first time when they published it was about, I think in spring of 2009, we had really scary developments. And now you see that the volume of world trade, the world equity markets were collapsing at a much faster rate than in the late 1920s, early 1930s. And as I said, this period back then was the worst economic crisis. Just look at trade. Within less than 1 year, the volume of world trade was collapsing by more than 20%. Incredible. We've never seen that. And nobody was expecting such a collapse. And what was surprising as well was world equity markets, because everybody's talking about 1929, that was the biggest stock market crash. No, we just went through it. At the time it was 50%, but we experienced a drop by 50%, incredible. So that the whole world economy, in spite or because of globalization, is much more vulnerable in the short term. Not in the medium term, but in the short term. And when you compare industrial production, the first 12 months, there was a reduction of more than 10%, like in the late 1920s, early 1930s. So that was a real shock and a huge surprise. And luckily, the policy response this time was much better than earlier, except in Europe, but this time it was better. We had, maybe I could just go back to this trilemma. The US, especially the US, had the option of a very independent monetary policy, that they were not concerned about the exchange rate, so they could really sustain the system by just printing money endlessly. They're still in this course, and that really made a huge difference. And possibly some fiscal stimulus also made a huge difference. So the policy response was much better this time. You see, about after 12 months, the economy starts to grow again and stabilizing. But the first 12 months were really scary, and I think everybody was surprised. The extent of collapse of the real economy was just was not expected.
Sorry, what is 1-0?
1-0 is the start of the downturn. And,
2007 or
no, it's April 2008.
Oh, sorry.
Yeah, so before it was still going up, and from this moment it's going down. It's a way to make it comparable. So, coming back to the beginning and to finish the whole talk, we were not surprised about the housing boom. That was clear that something was going wrong there. But the link from the housing boom to the financial system was, to me, unknown, and the extent of collapse was a big surprise. And in the second step, the contagion between the financial system and the real economy worldwide was, for me, a very nasty surprise. And some issues have been settled maybe, but there's still, at least for me, I'm still overwhelmed by the complexity of these leakages. All right, thank you very much.
Thank you very much, Tobias. It was stimulating few remarks and slides there, and I imagine there are a lot of questions. I have quite a few myself, but let's begin.
Okay, first of all, what is a hedge fund? Just out of interest, sure. Because in this middle layer that you explained is one of the institutions that's often blamed for corrupting the situation. And then the second question, which is a bit of a larger one, I guess many people have, is how do you separate out the EU's financial from its industrial crisis?
Yeah.
Because obviously, I mean, it's one thing to say that EU is bound to fail, but the politicians many times refer this to its industrial crisis. European markets are not competitive anymore. There's delocalization and so on. So how do you, as an economic historian, actually separate out these financial from these industrial components of the crisis?
First, well, a hedge fund is like any fund. You collect money and then you invest it somewhere. And the point is that the money, the hedge fund, for example, or a money market fund is collecting. This money is not going directly to the banking system, but it's going through one of these vehicles. And it's not important whether it's our pension system, or it's a hedge fund, or it's a money market fund, whatever. The point here is that there is no direct link between the traditional bank and these funds that are collecting cash. And the hedge fund, I think, is special in that it's mostly for rather rich people, and you're not, when you give the money to the hedge fund and the hedge fund has a crisis, you cannot withdraw your money immediately. There may be some hedge funds, but mostly you're stuck. Whereas when you give it to a bank, you're allowed to withdraw the money immediately, which is very dangerous, of course, for the whole system, because all of a sudden the bank has no money anymore. But then the central bank can stabilize it. But the hedge fund, it's a very private agreement between your money and the hedge fund. It's not very well regulated. You don't know exactly what they're doing with your money. But for the systemic question, it's not so important whether it's hedge funds or regulated mutual funds or whatever. But the problem is really that they're giving their cash to the traditional bank only by this intermediary shadow banking system, which is very loosely regulated and has been underestimated by many people. Of course, by me, but also by the regulators and by central banks. They were not aware of what was going on there. They were not aware of the systemic weakness and vulnerability. The second question, of course, what we know from history, and we knew it before the crisis, is that financial crises always have negative impact on the real economy or on industrial economy in the short run. And it's clear why, because the banks are really in the middle of the economy. When a bank has problems, of course, probably curtails credits or has higher interest rates, whatever, or when it fails completely, this is disrupting the real economy in itself. But so there is always a link, and it's in a kind. It's maybe stupid to separate. There's always a link in financial crisis between the financial system and the real economy. So you cannot really separate. Maybe I'll be more specific for the euro. Of course, when you look at, let's say, Italy, of course, Italy has an industrial crisis, a structural crisis, a political crisis, whatever. But the point is, the point is when you have an independent monetary policy, when you look at the trilemma, you're never going to be stuck in a crisis like Italy is now, because Italy has always had structural crisis, industrial crisis. It's always had a very difficult political system. But you have to go back very far. You have to go back to the 1930s to see a similar stagnation. Why? Because they don't have this tool anymore. Because with this tool, you cannot, of course, you cannot improve the industrial structure of a country, but you can. What you can do is, when a crisis is coming, in the short term, you're able to fight this crisis, and that's a strange thing that everybody's talking about as if Italy had a new structural crisis, but the crisis has always been structural. But now, in combination with this very rigid monetary system, you screw up everything. After this, to be honest, I'm very happy about the elections, because the Italians now say, well, we're not following you anymore. We need more freedom for our economic policy. And Italy is a very strong country economically, but it has some problems, and in combination with the Eurozone, they cannot manage their economy in the short run anymore. And the result is that you slide into a depression. And I tell you, everybody knew that this is very risky. If Italy manages to do all the structural reforms, maybe in 10 years they will grow again. But I don't think we have the time. Because structural reforms, until they really generate growth, that takes a very long time. This is not a recipe for now. This is like 10, 50, maybe 20 years. So even if the euro survives this crisis, it's going to be very costly. We're going to lose at least one generation in Southern Europe and so on. It's a human catastrophe already now. And it's really this combination of structural problems, I agree. But then when a country has structural problems, even more you should have an independent monetary policy. Otherwise you end up in depression. Many Italian economists, many Italian economists were for the euro because they thought if we abandon the independent monetary policy, if we stop devalue the currency each time we have problems, if we stop generating inflation each time we have problems, we can put so much pressure on the political parties, on the economy, that they have to do this structural reform. But we see now, no, they're not doing it. And what's the result? If that had been right, I would not be against, or I would not be skeptical. But we see politically it's not feasible. It's not feasible. But many Italian economists were hoping that by locking in Italy, we were going to see more flexibility and then a renovation of the whole Italian model. But it's not happening. So I think we should not talk about the structural crisis, talk about this lost freedom. That's the main reason for the short-term depression. Yes. Sorry. That's a very important point.
Continue on this really. But like you focus now especially on Italy, but isn't it much more? I mean, until now there was only a few countries going well in Europe. But most of Europe, whether it's north or south, west of Europe, I mean, there's much bigger structural problem in Europe, not only in monetary, but like countries like the Netherlands, in the recession, France is going neither well, and they're in kind of a situation like Italy, and maybe a bit because the debts are lower, but I don't know that there's much bigger. So would be really the option to exit Europe for all of Europe? I mean, then every country is going to the same, or there still is lost generation.
Yeah, that's too late. But you know, the point is many people say, well, the US is very different as well. When you go to the south, it's pretty poor. You see pretty poor areas, even poorer maybe than in Southern Europe. But the point is, it's a country with one currency, and it has a lot of labor mobility. People are moving from one. When there is a crisis, people are moving away. Maybe not as much as they should, but they're doing it, and much more than Europe. Yeah, but much less. Yeah, much less, not enough. That will accelerate, and it will help, of course, but it is not much. And especially the US has financial mechanisms. Or a lot of, for example, social security, the healthcare system, that's all centralized. There is an interesting comparison between Ireland and Nevada. Both had very huge banking crises. But when you look at these financial flows, they're very different in the US, because you don't. When Nevada has a problem, you're not stopping to pay social security. You're not cutting back. You're just paying as under normal circumstances. In Spain, for example, you have to cut everything now, and that, in the short run, curtails demand, and you're gonna deepen the recession. So you have a lot of stabilizing mechanism in the US. Another stabilizing mechanism is that you have a very integrated banking system. The comparison Nevada-Ireland, when in Nevada many banks were bankrupt. But they were mostly subsidiaries of big banks in New York or California. So the bank itself, could take care of these bankruptcies. In Spain, you have a completely national banking system. It's completely bankrupt, and the state now has to finance all these losses. That means the Spanish government is now bankrupt as well. So you don't have. That's the problem of Europe. You don't have any stabilizing mechanisms when one or several countries have some short-term problems. That's the main problem. It's not, I mean, the US has a lot of structural problems as well. It's very heterogeneous. It's not at all an ideal area for a common currency, but that's why they have these mechanisms. And Europe is politically not able to develop these mechanisms. If they are able to do it, great, then it's a fantastic project. But if you say A, you have to say B as well, and they're not ready to go all the way. And I think that's a consensus as well among economists. It's not per se a bad idea, but if you run it like a gold standard and not like a real country that, as I said, has these mechanisms of rebalancing, then you're doomed. It's not possible. It's not possible. Or just for 20 years or so.